Welcome to the lesson number 3. We will talk here in details about the joint venture operation, management, and control. As you can imagine, if the investing parties want a joint venture to have any chance of success, how the venture will run needs to be determined very early on. This includes how the venture will be managed, operated, and controlled, and who will be responsible for making those and other strategic decisions. Often these decision-making bodies take one of 3 forms. Either there is a board made up of representatives from each party, a management board within the joint venture itself, or all of the decisions are made by one or more of the parties. And sometimes it's a combination of these management forms. Many joint ventures function independently with their own management, but sometimes that management's authority is not fully scaled. For example, it might be able to make operational decisions, but strategic decisions need to be outsourced to a board or one of the individual parties. When it comes to creating a governing board, there are a lot of issues to look up for, including the board size and composition. Of course, it's also necessary to decide the board's voting requirements, veto rights, and the process of electing or removing board members. Then there is also appointing the board's chairman, backfiling any board vacancies, and delegating certain members to special committees. For special and key board committees, how the representatives will be appointed proportionally based on economic interest needs to be decided at this stage. And one of the most important parts in this stage is determining if the board members have fiduciary duties to the joint venture or not. As a refresher, let me explain that the fiduciary duty is an obligation of good faith, care, loyalty, or confidentiality. A fiduciary is legally bound to putting the company's best interest ahead of their own. If the board members do have fiduciary duties, several things need to be determined, including whether or not these duties can be legally changed or eliminated altogether. It's also necessary to determine the extent to which personal liability for breach can be eliminated, and if the joint venture can indemnify the members. Sometimes during delayed buyouts, the acquiring party wants the seller to continue being in charge of management for the interim period. When this happens, the seller then keeps the majority of the control over the business during that time. And as we've talked about in other lessons, some delayed buyouts rely on performance to decide on the purchase price. In these situations, whichever party has the management control during the interim period can ultimately influence the results of the calculation of the purchase price. One of the most important steps in establishing management control is that the parties must decide on a list of issues important enough to need approval from all parties. What's on this list obviously varies greatly from joint venture to joint venture, as all have their own combination of economic interests, industries, management practices, and procedures. But generally speaking, here are some of the issues that frequently top the issues list for joint ventures. So when it comes to issues on a structure level, the following are often listed: dissolution, liquidation, and bankruptcy, or changes in business scope, tax obligations, which legal form, or what are the governing documents, changes in dividends or equity, additional parties or contributions from current parties. Also, many other issues may arise in the joint ventures operations. There are so many in fact that you might want to screenshot or write down the list in the slide. Some of these issues are, for example, key employee, particularly the employee of the C-level appointment, compensation, dismissal, benefits agreements and plans, taking on debt, creating liens or capital expenditures, offering loans to or investing in third parties, merger with other businesses or a combination of them, short and long-term budget and strategy plan approval, external operating agreements, agreements such as exclusivity or non-competition, sale or purchase agreements of material assets. As I said, these are only some of the operational issues that might make the list. Of course, there are many other issues joint ventures add to their own unique list as well. And this might include changes in tax policies or the tax matters partner, changes to accounting appointments and dismissal or auditors, initiation or settlement of material litigation issues, affiliate transactions. As you probably assumed, once these issues are decided upon, once they arise, there are several ways the issues are voted or decisions are made. Sometimes this vote is simple and the approval is simply between the parties in the joint venture. Other times contractual consent rights are given to certain parties. Most often it's up to a board of representatives to vote on, and the votes don't always have to be unanimous. Sometimes it's a simple supermajority. Also, often it's enough if the same votes is cast by the majority of the board, so long as each party is represented. Other times, the parties elect certain members and it needs to be a majority vote from those members. Committees are often formed to keep things streamlined, and so that board members are not constantly having to vote on every issue facing the joint venture. Also, if, for example, one party retains responsibility for a certain part of the joint venture, they might establish a committee in which the majority of the members are from that party. As with all votes in life, there are often disagreements and deadlocks when it comes to the voting outcome. Generally speaking, fundamental disagreements or deadlocks in voting between the joint venture parties are not able to be solved through arbitration. Instead, there are other predetermined methods of coming to a resolution. And some of them may seem drastic, but remember, these are used when it comes to issues surrounding the fundamentals of the joint venture. There are many different methods used, but some joint ventures go for the seemingly simplest one. In the case of a deadlock, they use forced compromise to come to a resolution. In other cases, a third party is brought in to cast the deciding vote. This third party could be any number of the pre-specified people, but is usually a CEO or chairman of the joint venture parties. If there is a breach in the voting process, there may be changes made that negatively impact the breaching party. This could be changed to any terms if the joint venture, including exit rights, governance, and economics. If the only thing the parties can agree on is that there is no way of resolution will be found that will allow them to continue with the joint venture, more drastic measures are taken. These drastic measures include accelerated delayed buyout or general exit strategies, sale of the interest of one or both parties to a third party, sale of entire joint venture to a third party, or total dissolution of the joint venture. Of course, other arrangements such as put-call, option, or buy-sell may apply. If the parties opt to terminate the joint venture completely, they then must go through the processes of valuation and solving tax and other complicated issues. And as we previously discussed, the rights to intellectual property in the joint venture and any licensing agreements will also need to be determined at this stage. Not every dispute between parties is about fundamental business issues. Some are more minor disputes you might expect in any joint venture, or merged businesses, some are major disputes. But these disputes usually relate to performance or the interpretation of the joint venture contracts. In these smaller disagreements cannot be resolved via compromise or another informal solution. They need to go to the arbitration. And the arbitration provisions are agreed upon in the initial contracts. These provisions are made to ensure the arbitrator is impartial during the arbitration process. The provisions might include stipulations such as the location where the arbitration will be held, as well as the language used. As many joint ventures are created across borders, you can imagine how important this provision is. Another provision is how the arbitrators will be selected and if discovery will be allowed. The amount of any potential damages that may be awarded will also be stipulated, usually within certain limitations. Like with taxes, other procedures might need to be followed based on the location of the joint venture and the nationality of the parties involved. Usually the parties will have either a separate chapter in the joint venture agreements or they will conclude an arbitration agreement between them. Another issue that must be covered is competition within the joint venture itself. The competition may be how the parties involved in the joint venture compete with the joint venture itself or solicit its employees. This happens more often than you might think and is why joint venture contracts contain so-called non-competition covenants. There are limits to the scope of the non-competition covenants, and that scope can't surpass the restriction needed to legitimate purposes. These limits always include the duration of the non-competition covenants as well as its geographic scope. Equally important is that the business of the joint venture is defined explicitly. This is because whatever that business is determines its competition. Sometimes the parties are allowed to compete with the joint venture, but only if they have already offered the joint venture business opportunities and it's been turned down. The non-competition covenants might also stipulate that the parties involved must purchase the goods and services needed to run their business from the joint venture and vice versa. Many of these provisions must be looked over by antitrust counsel to ensure they don't result in anti-competitive activity. If you need a quick refresher on antitrust, we discussed it in detail in the lesson number 2. We've also previously talked about fiduciary duties, which is the obligation of the fiduciary to put the company's best interest before their own. So the fiduciary must also follow the corporate opportunity doctrine or a similar doctrine for their business. This doctrine stipulates that the fiduciary cannot steer business opportunities away from the joint venture and back to their own business. Often a joint venture and the parties that create it are in similar industries or markets. And this makes things both complicated and difficult, as often the question arises as to who the new business opportunities belong to. This is especially true when a fiduciary of the joint venture is also a fiduciary of a similar business entity. When there is a question as to whether or not the doctrine applies to a given issue or situation, it goes to the courts. But even the courts are often unable to give a definitive answer. This is because the court has to ask and answer a variety of questions such as: was the business opportunity already within the party's current business? Or was it developed using the party's assets? Is it essential or especially valuable to the party? Does the party fully understand the opportunity and can it realistically pursue it? So in order to bypass the courts, the parties can go through other methods to reach a common solution. And these methods should be clearly outlined so no other issues arise in the future. These other methods are: first of all, creating a provision that allocates new opportunities which might arise. Second, specifying the steps a party must follow to obtain consent on a case-by-case basis. Third, clearly defining the rights of the parties which have the technology or other resources developed by the joint venture. Fourth, clearly define which businesses and activities are carried out by the joint venture and which areas will be solely for the individual parties. Also, the fifth one will be clearly to define the areas of businesses and other activities in which competition between the parties and the joint venture is or is not permitted. 6. Stipulating that if a joint venture's director is also a fiduciary of one of the involved parties, the new business opportunities would only belong to the joint venture if the director received the offer while acting in their capacity as the joint ventures director. 7. Specifying exculpation and indemnification of fiduciaries. 8. Developing a waiver of the doctrine within the extent of the law. So, as you can see, setting up the foundation of a joint venture takes an extensive amount of time, research, discussion, and forethoughts. So far, we've covered everything except what happens when one or both parties decide they want out. In our final lesson, we'll be discussing these transfers and exits and the restrictions and strategies put in place to help them run smoothly. See you there.